We are officially in the second half of the year, and markets kicking things off with modest gains. The NASDAQ, the top performer on the day. Joining us now is Brian Vendig, MJP Wealth Advisors Chief Investment Officer. Brian, it is good to see you. So we had a real strong start to the year, Brian. It sounds like what you're saying is, listen, stay positive, more good times ahead.
Well, Josh, I think over the balance of the year, I think that is our tone right now. And I think it's predicated on the fact that we're expecting earnings to continue to expand on a sequential basis. But as we know, this first half of the year was dominated by some of those Mag 5, Mag 7 names from last year continuing to lead the charge, especially if you break that down over the last 3 months, with 9 of the 11 sectors in the S&P 500 trailing our friends in technology and communication services, where most of those sectors were flat or to negative, slightly positive on an overall basis. Big disparity in returns. But I think that has an opportunity to change because as earnings expand from areas outside of mega cap tech, and we start to see continued confidence in that slowing inflation story with rate cuts being more and more a reality from September on, I think that's where you have a chance for a little catch up in the markets.
So, Brian, my question to you is, does today's action maybe point to the fact that maybe some of that is at risk when you take into account what maybe the market was pricing in today? Looks like it was more of a Trump presidency, some of the risks associated with that, just in terms of the spending, the tax cuts, and what ultimately that could do to inflation. And then, of course, the conclusion being what that means for the Fed. Is some of that, are you confident that this disinflation trend is going to remain intact, or how much of that is at risk right now?
Shauna, that's a great question. I think in the last couple of days, the bond market is telling us that with this higher probability or near-jerk reaction of Trump coming back to the White House, we saw rates go up in the bond market with those concerns based on fiscal policy adding to inflation and the economy moving forward. But I'm looking at things from a let's get to the election first perspective, because as we know, it's really difficult to handicap politics. And so when you break that down, the consumer part of the story is what's really been driving inflation and sticking on that stickier side. And so with a slowing consumer, slower spending, we've seen, and we're going to get the JOLTS number tomorrow, we've seen less job openings, less leapfrogging with wage inflation, and also housing prices sticky, yes, but with demand supply and a little bit of a freeze there because rates are still high, we expect some of that data to change as real market data is showing up in the government inflation numbers. So we still feel confident that over the second half of the year, inflation will come down, rates will come down. The Fed has signaled that they want to cut rates, but they're playing the wait and see game because no one really knows. But at the end of the day, I think we're seeing some disinflation in the system, and we're seeing the expectation of better earnings. And that's why our tone is positive for the second half.
And Brian, do you think the market needs the Fed to cut in order to keep moving higher here? Or is it just, no, the market just needs to think Jay Powell wants to cut, is looking to cut?
That's a great point. I mean, I think right now the market is looking for clarity of policy. I think when you're dealing with the uncertainty, that's what's really holding back on business leaders and some other decisions to be made on where capital is going to be allocated. But I think right now the market is still having a pretty high probability for at least one rate cut in September. I think the futures market there is saying around 60%, and a higher probability has just ticked up in December. So we're still in the camp of 1 to 2 cuts, assuming that disinflation story creeping through over the summer months into the fall. And I think that's going to help the cyclical parts of the market. To go back to your question, you know, the last couple of days when the rates going up, is it a surprise that the cyclical parts of the market, like industrials, basic materials, take a little bit of a pause while technology keeps showing their leadership? We think not. I think if we get a little bit more confidence that that Fed policy is going to be there for cuts, that's where we'll see the cyclical part of the market have a chance to rebound. And that might even play into the small cap market as well.
I was going to say, Brian, so given that, what are you seeing in terms of the opportunity maybe within small caps and then even mid caps as well, given those expectations?
Yeah, Shauna, I mean, that's where just big picture, value paired with growth has been our theme for investors over the course of the year, and staying diversified. And I think when you break that down, you don't have to pay 30 times plus forward PE like we're seeing in some of these mega cap tech names to get growth. I mean, think about industrials with this rise of infrastructure spending that's still going to play out over the next 9 years, and data centers and other areas of making our grid smarter, healthcare, M&A transactions, innovation, new therapies coming out. And small caps have always been disproportionately punished. And that's been going on since March of 23, when we had 2 bank failures and people were concerned about a recession and rates and what's going to happen to smaller companies. Well, yes, they still need to play catch up, but from a reality point of view, they're usually the ones that price the bad news first, and then and knowing that that's behind us, then they're the ones that come out of those situations to actually bounce back first. And I think we saw that in the fourth quarter last year. And I think, Shauna, there's an opportunity for that to play out when there's more certainty around that Fed policy measures on rates, as I said before.
Brian, as you look for opportunities, do you want to stay U.S. focused, or do you see any opportunities overseas as well?
That's a great question, Josh. I think, we definitely we do have some exposure in international equities, but we're leaning more in the developed part of Europe and Japan. But our bias has been more focused domestically here in the U.S. And that's just because of concerns with changes in the dollar, as well as just recognizing some of these political uncertainties that keep coming up with policy, as we saw over the weekend with things going on in France, and also a little bit of this start-stop and what's going on in China. So right now we're leading more domestic, but we're playing a close eye on where the dollar is going to move post-election as we get a little bit more clarity on policy, both from a tariff as well as foreign policy perspective.
All right, Brian, great insight there. Thanks so much for joining us here today.
Thank you both.